the breakup of Dun & Bradstreet Corporation into 3 and then in turn 9 eventually, separate companies was a huge home run. That would be the greatest example that I could come up with of his mentality in being able to just sense how to enhance shareholder value.
Took the job in 94 and 96, restructured the company. The investment banker part of me, I saw that the property was dramatically undervalued for Wall Street reasons. And so when we announced that we were going to break it up, the market cap of the company was $5.7 billion. And 5 years later, it was $112 billion.
Dun & Bradstreet, one stock that did move higher today, closing at a multi-year high up 1 7/32 at 65. This after D&B announced a plan to split the 155-year-old business information giant into 3 publicly traded companies.
It was on the New York Stock Exchange, and it was the 50 most highly valued companies. It was an information conglomerate, mostly information-based, but companies serving very different markets with different kinds of services. So it was not in any way homogeneous. Wall Street isn't used to dealing with that kind of company. And so they had created homogeneity by calling it an information company. Well, it wasn't that. It was a series of information companies, very different. In order to run the business, we were trapped by our own operating results. We had very high margins, very high returns on capital, which limited the money that we could reinvest in the business. And we also faced the fact that the company was undervalued because no one could really clearly see all the individual pieces of this diverse puzzle. So I said, let's restructure it into individual separate companies where people can see it, which is what exploded the values. There wasn't anything the businesses did. It was just the revealing of what it was doing that wasn't visible.
We live in a world where you're either looking for synergies and therefore you've got the mergers going, or you're doing the spin-offs. You know, plenty of companies have been doing this very same thing. What does it say about the marketplace today where you either must have these back office synergies that you can use to save costs, or you got to have a separate entity so that it can achieve its full value?
I really think that what is required is discipline in the definition of synergies. We've seen cycles going back to the 60s and the days of conglomerates where the arguments have been made, and then the cycle seems to go the other way. I think the best way of coming to a conclusion if there's synergy is ask yourself questions like, are you dealing with the same customer? Do you tend to face the same competitors? Are there high shared costs? If the answer to those questions are no, you probably don't really have a truly economic case for synergy.
So I can remember vividly Bob calling a few of his executives into a conference room, checking to see how we were all doing great. How's the business? Great. Good, he said, because it's always important to make changes when you have strength. And Bob revealed to us the plan to break the company up. And frankly, we were going to create 3 new executive teams as a result of this. And you could then take those brands and help build those into the marketplace. They were all going to be public companies.
This is an historic day for everyone at Dun & Bradstreet. Last night, we announced a bold plan to transform D&B into 3 separate and independent global companies.
We tried to break it into pieces which worked in a financial sense and worked in an operational sense. Why not more? I would have liked more. The lawyers said if you try to do more than 3, the IRS will go tilt and never give you permission to do it on a tax-free basis.
Dun & Bradstreet was a brand that had been known for a lot of years. 2 presidents of the United States worked for the Dun & Bradstreet Corporation. So when we announced the breakup of Dun & Bradstreet, it was viewed as one of the most important and historical breakups of an American icon company in the history of Wall Street.
Now, you're relatively new in your job, right?
Yes, I am.
D&B had a image over the years, before you came, I should say, of being a very solid but rather stodgy company. You want to change that, obviously. And now, how will that change?
We will have what we're calling the new Dun & Bradstreet, which will comprise our credit reporting and Moody's rating services, as well as our Yellow Pages business. This will be a mature, solid, high profit margin business with a very good dividend. Cognizant Corporation, the new company that we're putting together, will be a very high growth vehicle. And it's a racehorse that we're going to allow to run. It is the world leader today in information for the healthcare market, media markets, and high technology. We think there are great opportunities.
And the third?
AC Nielsen Corporation, a great franchise, a great global business, the market leader in providing information to manufacturers and users and sellers of fast-moving consumer products. That's a turnaround story. Technology is moving, they're moving with it. We're freeing them up to follow their strategy.
So I remember vividly our investor and analyst call to announce the breakup. New York had one of its largest snowstorms ever that weekend. Who's going to be listening on Monday for what will be one of the biggest breakups in American corporate history with the snowstorm? And Bob was cool, composed, as he always was, and said they'll be interested, they'll be on the phone, snow or no snow. And sure enough, the instant reaction in the marketplace was what a fantastic idea to get more narrow, more focused, and to put investments into those businesses that made sense for clients and for the investors. Bob knew that one of the assets, AC Nielsen, the one that I went with, needed cash and no debt to survive as a public company.
D&B has committed substantial financial resources to Nielsen as it goes public. Bob Levency says it best. Nielsen is built to last. Nielsen has a real opportunity to be a star and to create significant value for employees and shareholders.
That capital structure that was set up by Bob did enable us to launch the AC Nielsen Company public. We did it at about an $800 million market value, and we sold that company 4 years later for close to $2.5 billion. So again, Bob Weissman's vision, his architect of the capital structure of each of these assets, including the one that I went with, AC Nielsen, was a fabulous and brilliant approach to a breakup in American history.